Welcome back to another episode of Multifamily AP 360. And today's our guest is Jeremy Dyer from RISE48 Equity. So welcome, Jeremy.
Yeah, Rama, thanks so much for having me.
Yeah, sure. A little bit about Jeremy Dyer is the VP of Capital Formation at RISE48 Equity. He has experience as both an active and passive real estate investor, currently holding passive equity in over 750 millions, maybe a little bit more now, across more than 5,000 multifamily doors and 37 real estate deals. Jeremy helps to connect professionals with passive real estate investment opportunities through syndications and multifamily investment properties. Jeremy lives in Lake Elmo, Minneapolis, or Minnesota, with his wife Marlene, their four children, and their dog. He enjoys coaching sports, traveling, and engaging in thought provoking conversations. So, with that, Jeremy, you want to add anything to your background?
Yeah, no, I appreciate that. Thanks so much, Rama. I'm ready to jump right in and excited to chop it up with you today.
Awesome, thank you. And I read like you traveled all 50 states. Share me a little bit more about that experience. What is some lessons learned from that?
Yeah, interesting question there. And you're exactly right. So I have hit all 50 states. In fact, as of this past summer, my wife and our family of six, we traveled to Alaska to check my final state off of the list as a family. But previous to that, I've largely spent the last 15 to 20 years traveling the country with our children in our 40-foot RV. Other than the fact that I do quite a bit of traveling for business and pleasure, it was real easy for our family to cross that many states off when we're effectively driving in a box around America, if that makes sense.
Yeah, great. Thank you. Thank you for sharing that. And you have invested passively in like in 37 deals across various maybe various operators or asset classes, right? So how do you evaluate and select the right projects to invest in, and what red flags do you look out for when considering a passive investment opportunity?
Yeah, it's a great question. And really, I think the moral of my investing story is really about diversification. So when I started investing as a passive investor back in 2015, my goal and objective was to not stick all of my eggs in one basket, right? It was to look for multiple different investment options as a passive investor, diversify and deploy capital with multiple different sponsors, multiple different asset classes, different business plans, and really take advantage of compounding or stacking investments on top of each other. And now I'm in a scenario having been a passive investor for over a decade now, where each year I'll have a few investments that will ultimately go full cycle. And then, of course, I can redeploy that capital through the 1031 exchange into a new investment opportunity. And each year I receive enough passive income through distributions where I'm now in a place where I don't have to add any new capital to real estate. Rather, I can just continue to recycle those distributions from the 37 deals that I'm in right now.
Yeah, thank you. Thank you. Any lessons learned from investing in 37 deals, some good and bad best practices?
Yeah, the most important thing is obviously selecting the right sponsor. And beyond selecting the right sponsor, there's also a timing element to investing in real estate as well. I am unapologetic to tell people that my 2021 investments will not do as well as the investments that I've made in 2023, 24, and 25. And why that's the case is simply because of the historic run up in interest rates that really sent a shockwave to the real estate market back in 2021. And so, just because of the sheer cost of the debt service on some of those deals that I've personally invested into back in 21 and 22, is really going to cause those deals to not perform as well. So, I think the prudent answer to really investors is to really adopt the dollar cost average strategy to diversify. But all of that to say, there's always going to be headwinds in real estate, right? I always like to say that birds fly, fish swim, and real estate falls apart. It's just what happens, okay? It's not a sexy asset class because there's always things that cause challenges for the operator. I call that execution risk. And so really it comes down to aligning with a real estate investment sponsor or syndication team that has the ability to pivot the business plan, has the ability to be able to navigate their way through things like the historic run up in interest rates, right? The cost of materials increasing, labor shortages, higher costs for property taxes and insurance costs, right? There's all kinds of different things that the real estate market is going to experience as headwinds in the future. And that's why it's incredibly important that investors select the right investment sponsor that has a track record, that has a team that they're surrounded with, that has gone through different real estate cycles in the past. And that gives me a lot more confidence, that sponsor then is able to reduce what I call that execution risk.
Yeah, thank you very much for sharing that. And real estate is a cyclical, right? And every real estate cycle it will bring different challenges, different opportunities. So, what kind of indicators you look for when looking for different cycles?
Yeah, it's a great question. It's difficult to time the market, right? I remember back in 2016, 17, and 18, all the experts were shouting that a recession is coming, a recession is coming. If you sat on the sidelines during that time period, then you missed out on a bull run up in real estate, okay? The challenge with real estate, just like exists in Wall Street, is the bull takes the stairs and the bear jumps out the window. Okay. At the time of this recording, it's March 7th. And if you look at the Dow Jones and the NASDAQ, it's the bear jumping out of the window, right? Now, I don't know where the equity markets go from here, but what I do know is in commercial real estate, that bear jumped out the window when the Federal Reserve Bank started historically running up interest rates. The same thing happened during the global financial crisis, right? And those types of experiences are set to happen again. So the question is, we don't really know when the next black swan event is going to be. What we do know is there are times where investors are over speculating, okay? When everybody is starting to run into the market, that's usually a good sign and an indication that it may be time for investors to pump the brakes, okay? But there are other times, like perhaps maybe the time period that we're in right now, where there's a lot of uncertainty and there's fear in the markets, right? And as Warren Buffett likes to say, be greedy when others are fearful, and be fearful when others are greedy.
Yeah, awesome. Thank you very much for sharing that. And you had an impressive transition from successful career in corporate sales to real estate investing. So, what inspired you to make that shift, and what were some of the biggest challenges you faced in moving into real estate?
Yeah, it's a great question. I appreciate that. I really wanted to get off of the hamster wheel. Okay. I was stuck on a hamster wheel. The quota was increasing every year. The suite of services continued to get more and more complex. There was more competition in the marketplace. So it was really harder to win business coming out of the tech sales job that I was in for almost 25 years. So when I first got involved in real estate back in 2012 as an active investor, and then a transition to passive investing in 2015, really my long-term goal was to be able to build up enough assets that produce regular, consistent cash flow so that I wasn't so dependent upon crushing the commission checks and the bonuses, right? It didn't happen overnight. Okay. Investing in real estate is not a get rich quick scheme. Okay. But it is amazing what can happen if you're invested in real estate over a 5 to 10 to 15-year period, and you continue to redeploy and recycle that capital and add new capital into real estate. It really puts you in a nice position 5, 10, 15 years later to be able to walk away from the W-2. And I was effectively able to do that because of the real estate investments that I was choosing to deploy my capital into back 15 years ago.
Yeah, definitely. Real estate is a long-term game. Yeah, totally agree on that. Thank you. And capitalizing is a critical part of any real estate syndication. Can you walk us through your process for identifying and attracting the right investors to participate in a deal? And how do you tailor your approach to different investor profiles?
Yeah. So, in order for syndication teams or operators to acquire a property. Okay. This is, of course, asset class agnostic, but in order to do that, most operators are going to need to leverage other people's money, right? We call it OPM in the business. And so effectively, what I am and what you are, Rama, in most cases, is we're just simply limited partner investors that choose to partner with an operator who maybe needs to bring together 100 to 500 different unique limited partner passive investors in order to be able to have enough equity in order to acquire the asset. Okay. Banks 4 years ago allowed operators to acquire assets with an 80% LTV or loan to value. Now it's around 60 to 65%. So most operators in the space today that are raising capital, they really need to raise more money on the front end in order to be able to acquire those properties.
Yeah. Thank you very much. So in today's market, investors are becoming more cautious due to economic uncertainties. So how do you navigate investors' concerns and build trust, especially when it comes to capital preservation and risk management in multifamily investments?
Yeah, it's a great question. And really, what you're hitting on here is that trust factor, right?
Yeah.
I encourage all investors not to invest in a slick pitch deck, right? Don't even take my words for it. You're not really investing necessarily in the property itself or the highest IRR or even really the business plan. Really, what you're investing in is you're investing in that lead sponsor and the team that they're surrounded with, their ability to execute that business plan amidst future black swan events, amidst future headwinds in the real estate market. So I would just say it's incredibly prudent for investors to really know and understand that's the most important factor. And when it comes to my and our ability to communicate with potential passive investors, really at the end of the day, what builds trust with people is transparency and authenticity. Okay. So connecting with people in a genuine, authentic way, being incredibly transparent about the process, the risks involved, right? That investing as a real estate investor, A, is not a get rich quick scheme, and B, there's the potential of you losing money. And so it's really important that we build that trust with people by being authentic and transparent at the same time.
Yeah, good. So just follow up on that. So when it comes to transparency, what are some best practices you use to to ensure transparency and long-term trust throughout the life cycle of a deal?
Yeah, like I said before, there's always headwinds, right? There's headwinds, there's execution risks involved, especially with our strategy of renovating 100% of the classic interiors. And some of the properties that we acquire have 250 to 350 units. And a lot of times they're 95% occupied when we take them over. And so there's a lot of transition that needs to happen over the course of that investment hold period. And there's always going to be challenges, right? There's going to be eviction challenges. Okay. There's going to be higher cost challenges, whether it be labor or supply shortages. And it's really aligning with the right sponsor and right team that has the track record, that has performed in the past under those types of circumstances, but also our ability to make sure that investors are always made aware, okay? On a month by month basis, we communicate with all of our investors, all of the information that it's necessary for them to know and understand about how we're executing the business plan, where we're at in the process, what are some of the challenges maybe that we experienced over the last 60, because we really, if you think about these types of investments, we're really like the airline pilot, right? And all of our passive investors are passengers on an airplane. If there's some turbulence, okay, on an airplane ride, guess who's going to get on the microphone? The pilot. And he's going to let people know, you got to buckle in. Here's what we're experiencing. Maybe we're going over some rocky mountains or something like that. And that's causing there to be a little bit of turbulence in the air. And so it's really important for the lead sponsor to be able to communicate back with the passive investors when there are some headwinds, when there are some turbulent times that they may be experiencing over the course of that investment hold period. And I think what that gives us, Rama, is it gives our investors a lot of confidence, right? That they're right along with us on this investment journey. We're giving them full access to all of the financials every single month. We're letting them know exactly where we're at from a pro forma perspective. They have access to the balance sheet and the income statements, right? And the general ledger. All of that information is available to them no differently, really, than the information that we're providing to the senior lender. And the senior lender that carries the loan is actually the largest single investor in the property. And so we're really giving our limited partner passive investors the same information that the senior lender requires as well.
Awesome. That's a good analogy. Thank you for sharing that. So, what are some of the trends you're seeing in the real estate market right now, especially in the multifamily sector? And how are you positioning your investments to adapt to these changes?
Yeah, really, there's kind of two main things that are happening right now in the real estate market. Number one is interest rate risk. Okay. Interest rates are incredibly volatile right now. Okay. Certainly, we went through a historic 14-month run up between June of 21 and July of 22. And then we started to see in quarter four of 2024, the Federal Reserve Bank was signaling lowering the federal funds rate, which happened. However, the 10-year Treasury, which is largely where interest rates are based off of, went in the opposite direction. Why did it go in the opposite direction? Some might say the Trump effect. Others might say the talks of tariffs and how those might impact or apply pressure to interest rates going forward of that particular environment. But that's a big factor right now, right? Interest rates and cap rates or valuations go hand in hand with one another.
Yeah.
So, really, at the end of the day, we don't know where interest rates are going to head in the future. What we do know is that inflation is still a concern. And as long as inflation is still a concern, then I would expect to see higher interest rates on into the future until it's deemed that inflation is under control. The one other pillar that's happening right now in the commercial real estate space is really related to supply and demand. Okay. We saw a glut of new supply in certain markets in this country as a direct result of low cost of debt, as well as a lot of migration. Okay. If you think about an apartment community, if you're going to build a brand new apartment community, it's going to take 36 months to do that, right? So what we saw is in the last 24 months, we saw a lot of new supply flooding the market. Those developers started building those communities when interest rates or debt costs were low.
Yeah.
So what we now know is the new permits in apartments have largely fallen off a cliff. And why that's the case is because, again, the cost of debt is so much more expensive today. And so we know already what the new supply outlook is going to look like for the balance of 2025, all into 2026, and even halfway into 2027. We know that with confidence because, again, remember, it takes developers 36 months to resurrect a new apartment community and lease up that property. That's a good thing if you're a real estate investor, to have supply fall off a cliff and to have a high percentage of what we call absorption of those new units that are coming online, because any supply shortages are only going to increase the valuations of those properties, of course, depending upon where they're situated in any particular market.
Yeah, thank you for touching on both aspects. How exactly higher insurance costs on real estate taxes impacting overall multifamily space?
Yeah, costs have been going up across the board, whether it's property tax costs or whether it's insurance costs or it's labor costs or supply costs, right? Costs are going up across the board. Some markets across the country are impacted higher than others. One of the ways that we mitigate against some of those higher costs is when we acquire a new property to renovate, we get fixed rate pricing up front. So if inflation continues to be a sticky point or sticky challenge for us over the course of the next 2, 3, 4 years as we renovate a property, we actually secure fixed rate pricing up front. So even if inflation continues to increase the cost of materials, labor, and so forth, we're really mitigating against that by securing that fixed rate pricing on the front end. But the things that we can't control, of course, are higher insurance costs, higher property tax costs. There's certainly ways that we try to mitigate against some of that. But as long as inflation is here and prices are going to continue to go up, it's going to be a challenge. But the good news about multifamily real estate and really real estate in general is it can also act as a hedge against inflation, right? Because as we see organic inflation prevalent across the country, when costs just simply go up everywhere, eventually those costs end up manifesting themselves in the cost of rents as well. The good news is in the last couple of years, as organic rent growth has largely slowed or even gone negative in some markets, we've actually seen wage growth increase fairly substantially in that same time period, which means that the consumer has more purchasing power. And when the consumer has more purchasing power, there's a better chance that they're going to be able to afford a newly renovated unit. If we, for example, renovate a unit and push the rents by $200 to $300 per unit, the consumer is more likely to be able to afford that.
Yeah, thank you. Thank you. So, would you share any of your best real estate investing experience? Could be active or passive.
The best experience that I had was when I chose to go passive back in 2015 after having renovated some single family homes and wholesaled some homes. I do write about this in my book, The Fundamental Investor, but a couple of straws that broke the camel's back when I made that transition from active to passive was as I really got tired of walking into single family homes and seeing some very unfortunate living conditions. For example, things like meth labs and marijuana farms and stripper poles, right? But really, the straw that broke the camel's back for us was when we flipped our last single family home and we were set to make $80,000 in profit on that flip. But the day before closing, the inspection report came back and the septic system had been earmarked as failed. Okay. And so for the low price of $35,000, which included a new septic system and new landscaping, that really ate into almost half of the profit that we were set to make on that flip. And really, second to that, along those same lines, is one of the main reasons why we got out of single family real estate ownership and went to be passive investors is really because of our time, right? Our time coupled with the fact that we were receiving very similar returns as passive investors in real estate that we were receiving as active investors. So it really made more time or made more sense, I should say, for my wife and I to focus on spending more time with our family and focusing in our careers than it made sense for us to continue down that, path or avenue of active real estate ownership.
Yeah, got it. Thank you. Would you also share any challenging experience?
Yeah, I think I stated the challenging experience for you already. I've had challenging experiences as a passive investor as well. There's no guarantees in any type of investing. And that's why it's incredibly important that you invest with the right operator or sponsor. Some deals that I invested in and back in 2021 and early 2022 have needed some additional liquidity. The sponsor has needed to raise some additional funds from those passive investors in order to either A, buy down the principal balance on that loan or extend the loan horizon out a couple of additional years as they need more time, for example, to renovate the remainder of the units, force NOI growth, and ultimately hope to sell in a couple of years from now, depending upon where their interest rate environment is at that time. But again, going back to the supply side, that's why a lot of sponsors right now are really wanting to hold on to their assets and not sell them, is because of what we know is going to happen on the supply side and that shortage in a couple of years from now.
Yeah, got it. Thank you. So, any personal habits that are helping you to be successful?
I really try to remain as I seek clarity. Okay. I try to stay focused and I seek clarity. The truth is that there are a lot of people, both in real estate and just in business in general, that get distracted. Okay. I think it's really prudent for people to stay focused on what's important, have clarity in terms of what they choose to spend their time on. The truth is, there's a lot of things vying for our attention right now. And some of those things are worth our time, and some of them just simply are not. So if you want to be successful in business and in life, I think it's incredibly important that make sure you have clarity, you have purpose in terms of what things you're focusing on and what things you're giving your time to. And really challenge yourself on a daily basis because it's very difficult. There's lots of distractions out there. And
Yeah,
so it's really a constant daily reminder for us included that we really dial in and focus on the highest and best.
yeah, yeah, good points. So any personal learning that played major role or major impact on your business or personal side?
Yeah, the people that I've surrounded myself with, they always say your network is your net worth. And so when I was younger, I sought out a lot of mentors. Okay. I have a lot of mentors today. I call them my personal board of directors, right? People that I can reach out to talk about maybe challenges that I'm having personally, professionally, obstacles that I'm looking to overcome. And sometimes you just need somebody to breathe life into you. And so I would encourage everybody out there to find a mentor or two, surround yourself with a personal board of directors. And you know what? If you're unwilling to do that's okay. And here's why, because there's a lot of mentors out there right now that have written books. There's a lot of mentors out there right now that host a podcast. Okay. And I've told people before that they've been an incredible mentor to me and they didn't even know it. And the reason why they didn't know it is because we had never met before, but I've been following them on podcasts or I've read their books. And there's a lot of power in that type of mentorship as well.
Yeah, yeah, absolutely. Thank you. So any books that impacted you?
Yeah, I've read a lot of books. One of them that I really like in the real estate space specifically is the Hands Off Investor book by Brian Burke. Highly recommend all sophisticated real estate investors check out a copy of that book. This past year, I spent nearly 600 hours writing my own book, which is called The Fundamental Investor. That book hit number one on the Amazon bestseller book in the category of real estate investing back in November. So definitely encourage your listening audience to check out the Fundamental Investor book if they'd like to learn a little bit more about my personal and professional journey.
Yeah, would you share a little bit more about fundamental book at high level? Yeah,
Yeah, absolutely. This conversation has been a little bit of a commercial of what that book entails already. But that said, I wanted to make sure that limited partner investors knew and understood the most important factor when it comes to deploying their capital into a real estate deal. And that is it's all about the sponsor, right? I
yeah,
also wanted to make sure that limited partner or passive investors know all the different intricacies of syndication investing. What are the benefits? What are the potential risks? What's the vernacular? What are all the different acronyms that people use in this space? What are the projected returns? What are the different ways that sponsors need to keep their head on a swivel and be adaptable over the course of that investment hold period? So it's really, I really wrote that book as more of a story outlining my journey, both from being a professional in a corporate job to an active investor to then a passive investor and somebody who's now deployed capital with multiple different operators, multiple different asset classes, and have been really largely doing it for almost the last 15 years now.
yeah. So
That's right.
yeah, awesome. So how can listeners can connect with you, Jeremy?
Yeah, thank you for asking. So you can definitely head over to our website, rise48equity.com. You can certainly email me directly, Jeremy at rise48equity.com. I'm also fairly active out on LinkedIn, so you can find me under there under Jeremy Dyer, and it's Dyer.
Awesome. And it was a great conversation. Thank you very much, Jeremy.
Rama, thank you for having me.
Sure, absolutely.